Hello again, everybody. This is Dr. Wright. Welcome back. We're doing online module number 6 for ManEc Fin 453 today. You can see that the title of our module today is Dynamic DCF Inputs. Once again, let's find ourselves on the map. And I should point out that we have a slight modification to the map. So last time we did a discounted cash flows model primer, and we built a very basic discounted cash flows model in Excel. I realized that in order to do this well and do it right and to not rush you, we needed to do 3 modules on the discounted cash flows model. So the slight change that I made is, whereas previously this 6th Excel module was going to be simulation analysis, Monte Carlo simulation, I have bumped the Monte Carlo simulation to the 7th module, and we'll just be talking about the inputs to the discounted cash flows model today. So what that means is I have cut out the residual income model with simulation analysis. I don't think that's going to be a problem, so we'll do 3 modules on the discounted cash flows model, and then we'll just do 1 module on the residual income model. And we won't be worrying about Monte Carlo simulation with the residual income model, because I think once you see me do the Monte Carlo simulation with the discounted cash flows model, you'll see how you could easily apply it to the residual income model. So that's the slight change. We'll spend 3 modules on the discounted cash flows model today. We want to just talk about how to get the inputs. Specifically, we want to come up with an Excel model that has dynamic inputs for your discounted cash flows model. You can look at the Excel training and review objectives here. Again, today we're just going to be talking about basic Excel functionality and hotkeys, although I am also going to give you one more add-in today to expedite data downloading. So our goals today, I want to help you become familiar with the FRED add-in that's provided by the St. Louis Federal Reserve Bank. And we want to use that FRED add-in and the previously distributed SMF add-in to develop dynamic inputs to the discounted cash flows model. All right, let me show you very quickly how to import the FRED add-in. It's very simple. All you need to do is pull up a Google search page, type in St. Louis Fed and FRED add-in, and it will bring you to this page right here, the first option. Click on that. So this page at the St. Louis Fed will explain what the add-in is, and then you can see that you can download a Windows or a Mac version, but I would caution you that the Mac version is a beta version. Click on the download now. Follow the on-screen commands, and if you get stuck, you can just go through the user's guide. So I'm not going to spend a lot of time showing you how to do this. It's relatively straightforward. Once you do get the FRED add-in, and you're at the home page at Excel, there will be a new ribbon up here called the FRED ribbon. And it's going to give you a lot of really powerful tools that you can use to import economic data directly from the web into Excel. So we're going to use that in today's Excel assignment. Just as a brief reminder, here's our discounted cash flows model. Anytime we want to find the current fundamental value denoted by P0, we have to forecast out all of the free cash flows, discount those back using WACC, and then in this terminal period we have to calculate our terminal price, and we discount that back, T periods as well, capital T representing the time till terminal period. Then we have to subtract out the value of debt. That's all review from the last module. And also remember that we use WACC, generally speaking, whenever we're using the discounted cash flows model. And WACC is the cost of debt times 1 minus the marginal tax rate times the percentage of the total value of the firm that's financed through debt, plus the cost of equity times the percentage of the firm that is financed using equity. So what we want to do today is find a way to estimate dynamic inputs for each of those variables that we need in order to execute this model. So we're going to need free cash flow estimates, we're going to need a WACC estimate, we're going to need a steady state growth rate estimate, we're going to need to know what the total value of debt is for the firm, and we're going to need all of these components for our WACC. So let's move ahead. One of the most difficult things to come up with is actually just calculating the free cash flows to the firm. Now remember, in our Excel model, we're actually using a shortcut method to forecast those free cash flows to the firm. What we're going to do is calculate the free cash flows to the firm in the last period in which we have audited financial statements, and then we're just going to start growing those free cash flows at an initial growth rate, and we're going to eventually take that growth rate down to a steady state growth rate. So one of the first inputs that we're going to need is we're going to need the year zero free cash flows calculated, not estimated, but calculated from the past financial statements. So let's talk about free cash flows to the firm for just a second here. You know from previous classes that free cash flows to the firm are operating cash flows minus net capital spending minus increases to net working capital. Operating cash flows are defined as EBIT, earnings before interest and taxes, plus depreciation minus taxes. Net capital spending can be calculated as ending net fixed assets minus beginning net fixed assets plus depreciation. And then increases to net working capital is just the ending net working capital minus the beginning net working capital. That actually is a fairly laborious way to calculate free cash flows to the firm. There's actually a shortcut method to arriving at the same calculation. So here's the shortcut method. We can actually go to the cash flow statement. So let me show you this for a second. I have pulled up the cash flow statement for ExxonMobil, and I want you to notice a couple of things. Right here on the cash flow statement, they actually have a line item that is net cash provided by operating activities. But you need to understand what's in there. If you look at it, what they do is they start from net income. And then they make all these adjustments for non-cash items that are captured in net income. And then what they do is they actually capture changes to net working capital. So really, on the cash flow statement, these operating cash flows are actually operating cash flows minus increases to net working capital. So right away we can drop out the increases to net working capital and we can just use operating cash flows to represent both of these variables. However, there's one problem with that. Please notice in the traditional definition of free cash flows to the firm, we want to start with earnings before interest and taxes, add back depreciation because that's a non-cash expense, and subtract out taxes. So another way to think about operating cash flows is earnings before interest and depreciation. Unfortunately, we don't quite have that on the cash flow statement. Now, sure enough, they add back depreciation for us, which is great. So they take net income and add back depreciation. Net income, which is what they start with, already subtracts out taxes. So in essence, what they're giving us is earnings before depreciation. That's what they're ultimately giving us on the cash flow statement. But what we want is earnings before interest and depreciation. All they're giving us is earnings before depreciation. So what we have to do if we're going to shortcut it is grab the operating cash flows from the cash flow statement. That's going to substitute for both this and this. But we have to add back interest expense because we wanted earnings before interest, but they took earnings after interest. So on the cash flow statement, we have to add back interest, but we have to take into account the fact that interest expense provides a tax shield for us. So the true net interest cost to our firm is that interest expense times 1 minus the marginal tax rate. So operating cash flows from the cash flow statement plus the interest expense times 1 minus the tax rate, that term will substitute for both the operating cash flows and changes to net working capital. Now, we also have a way to shortcut the net capital spending from the cash flow statement. However, you're going to have to make a choice when you do that. Let me go and show you the cash flow statement for ExxonMobil, and you'll see what I'm talking about. In the most recent year for which we have audited financial statements, you can see here is the investments section of the cash flow statement. Right there we see additions to property, plant, and equipment of $30 billion. You could just grab that. You could say, well, there is their capital spending. That is ExxonMobil investing in new property, plant, and equipment. That's one choice you can make. The other choice you can make is to include all of the other cash flows in this category. The reason you might want to do that is because the very next line is proceeds associated with the sale of property, plant, and equipment. So technically those two numbers together are going to give you net capital spending. However, you'll see from the RCH get element number function that it doesn't give you the option of just picking these two. Either you have to pick this line, which is just the money spent procuring new property, plant, and equipment, or you have to pick this bottom line, net cash used in investing activities. That number actually includes both of these two, but it also has some other line items that we're not so interested in, specifically additions to marketable securities, sales of marketable securities. That's not net capital spending. Also additional investments and advances. That's not net capital spending. So you kind of have to pick your poison when you shortcut this. Either you just pick cash spent on capital equipment, or you pick the whole thing which has some lines that you don't want in it. So we'll make a choice on that as we move forward. You can see that the deliverables for this assignment look very, very similar to the deliverables from the last assignment. That's because we're using the same framework. Our only goal today is to make sure that all of the white inputs over here are dynamic and automatically refresh either with the click of a mouse or the press of a button. So let's go to the Excel assignment and let's start working on this. So the first thing that you can see, and I've highlighted the inputs in blue that we want to actually make dynamic. As we make them dynamic, I will then highlight them in white. So here's our first yellow input. That's just the ticker symbol. You type in the ticker symbol of your company. Now, the first input that we want to make dynamic is the date of the financials. If you look at the RCH get element number list and you look at 3302, so go to 3302 on the list here, and you can see in fact that 3302 is the annual income statement date, and it gives you the date of the most recent annual income statement. So if you did RCH get element number and you want to use the ExxonMobil ticker symbol and you put in 3302, this is what will pop up. It says the 12 months ending December 31st, 2011. Now we don't want all of that. All we want is this part of it, which is not a problem. If you look at that, we just want these last digits over here on the right. In fact, how many digits do we want? We want 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So if we just take the right 10 most digits from that, we'll have what we want. So we're just going to use the right function, keep the RCH get element number function inside of it, and we just want the 10 digits to the far right. And we actually get that date. And so we have the date that we want. So we now have that input dynamic, so we don't need a color. The next thing we want is we need our year 0 year. In other words, what is the last year in which we have audited financial statements? This is very easy. We just take the year of that date like so. And once we do that, we now have a dynamic year to our spreadsheet. So we're moving very quickly here so far, but we'll have to slow it down here. All right. Now we get to one of the more challenging dynamic inputs. We want year 0 free cash flows. In other words, what were the free cash flows in the last period in which we have audited financial statements? Let's remind ourselves what we want to do is this. Operating cash flows plus interest expense times 1 minus the marginal tax rate minus net capital spending. So let's go back to the spreadsheet and let me show you how we're going to accomplish this. What you can see is I've already created a second tab. Let's label this free cash flows to the firm. And what you can see is I've already put the framework in here. What you can see is I'm first off going to obtain the total debt for the firm because we're eventually going to need that, and then I'll work on the operating cash flows. If you look at it at RCH get element number 3782, so let's look at 3782. You can see 3782 is the annual balance sheet for the most recent fiscal year, and it's the total liabilities, which is what I want for total debt. Some people say you should only use long-term debt. Let's not have the argument right now. But for my purposes, I'm going to prefer to use total liabilities because in my mind that represents the amount of their total assets financed with debt. So I'm going to use 3782 to get the most recent total debt from their balance sheet. If you look at RCH get element number, you can see that these total liabilities will go back 6 years for us. So we might as well do that. But the trick is, why don't you link this year up to what you have here on the front page? So we know that's going to be the most recent year we have. And then right here, just take that year and subtract 1. That way, when the new financial statements come out, that number will automatically change to 2012. And so will that number. So let's go ahead and do RCH get element number. And in this case, we want to use this ticker symbol. and we want to use the element number in B3. So we do that, and it's going to give us the total debt on ExxonMobil's balance sheet. Now we need to lock in this B4 because that's the ticker symbol, and we don't want that to change. So we lock that in, and we can take this all the way down, and that will show you the total liabilities on ExxonMobil's balance sheet for the last 6 years. We won't worry about the error message. For some reason, the RCH get element number function is not allowed or not able to go get those 2 years, but we don't really need them. They would just be nice to look at. So next what we want to do is we want to go and get the operating cash flows from the cash flow statement. If you look at the element number, it's 3896. So let me show you 3896. There it is. It's cash from operating activities in fiscal year 1. And we can get that for the previous 6 years. So let's go ahead and do that. RCH get element number. Again, we want that ticker symbol. And we want the element number in E3. So we lock in that B4 because that's the ticker symbol, and once we do that, we should be able to pull or drag this formula all the way down in the column, and it will give us what we want. And so there you see we have the operating cash flows. Now remember what we need to do to the operating cash flows. We need to now add back interest expense times 1 minus the marginal tax rate. So let's go ahead and get the interest expense, and it turns out that the cash spent on interest expense is a line item on the cash flow statement, which is very helpful. So if we look at 3962, we can see that the definition for 3962 is cash interest paid in fiscal year 1. So that's 3962, and then again we can get it for the previous 6 years. So one more time, we use the RCH get element number. We go and get the ExxonMobil ticker symbol, and now we want the element number that's contained in cell G3. We lock in B4, and once more we should be able to drag this down. So in order to get net operating cash flows, which remind yourself, net operating cash flows for us actually means operating cash flows minus changes to net working capital. In order to get that combo, what we have to do is take the operating cash flows from the cash flow statement and add back this interest expense after we consider the tax shield. So let's take the interest expense, multiply it by 1 minus the marginal tax rate. Now, admittedly, you could make this a dynamic input as well, but I'm just going to use 35% as the generic marginal tax rate. In reality, it's probably a little bit higher than that when you consider local and foreign taxes as well. But we'll just use 35%. So what we've done is we've taken the interest expense, multiplied it by 1 minus the marginal tax rate. Now we need to add the operating cash flows, and that gives us the actual net operating cash flows for that period. Again, we shoot that down. Next, we need net capital spending. Remember, this is where you have to make a choice. If you look at 3902, 3902 is capital expenditures. Now remember, you have to make a choice. Either you're going to do capital expenditures or you're going to do all cash from investing activities. So either you're going to do 3902 or you're going to do 3914 depending on the choice you make. I'm just going to do capital expenditures 3902, which means I'm making the assumption that in most years this is all that matters, additions to property, plant, and equipment. And I'm going to make the assumption that in most years the proceeds are not huge. So all I'm going to do is RCH get element number. Again, go get the ticker symbol, except this time we want the element number that's located in K3. Again, we lock in B4, send that on down the line, and now we can get our free cash flows very easily. All we do is we take the net operating cash flows and we add this net capital spending. The reason we're adding it is because it's already a negative, and that's going to tell us what our free cash flows look like. And if we're lucky, it'll go back 6 years. Right now, it's only going back 4. So you could just calculate the growth rate and see what that looks like. But main point is they're free cash flows to the firm using our shortcut methodology and making an assumption or two. Free cash flows to the firm for ExxonMobil in 2011 were $24.7 billion. That's going to become this input right here, year 0 free cash flow. So all we're going to do is hit the equal sign and go click on that button right there. So that now has become a dynamic input. Year zero value of debt is nice. We've already gotten that over here. So we're just going to link those up. We'll hit the equal sign and we'll go and grab that. That now has become a dynamic input. Scale on the financial statements. This is very important. Unfortunately, there is no RCH get element number that you can pull on it. If you go and look at the financial statements, and I'm at the SEC website, you'll see that all of their numbers are in millions. So we have to make note of that. It's one of the few things that the user actually has to go out and pull. So we type that in. Now we want year zero markup. If you look at RCH get element number, so if you go to the element numbers and look at 1541, notice that 1541 is the market cap. So we're going to just do that. We're going to do RCH get element number, ticker symbol, and we want 1541. However, that's going to be a raw number, so we're going to have to scale it. You can see that their market cap is 407 billion, but we need to scale that by millions since everything else on here is scaled by millions. So their market cap is 407 billion. That's now dynamic. Year zero shares outstanding. If you go and look at the element numbers and just look at 6, you can see that's shares outstanding. So you can guess what we're going to do. RCH get element number, go get the ticker symbol. We want 6, but again, we have to divide it by the scale on the financial statements. That has now become dynamic. So we're making very good progress here. And remember, everything that otherwise would be in billions has got to be scaled by this number. Otherwise, you're going to get very odd results. Now, we want to talk about the year one growth rate and the steady state growth rate. For the year one growth rate, I'm going to shortcut it. Here's how I'm going to shortcut it. I'm going to assume that earnings and cash flows are perfectly correlated. Now look, I'm not going to take the time to investigate that, but you could. You could go map out the earnings for ExxonMobil, and you could run a correlation between free cash flows and earnings. And actually, you wouldn't want to do that. You'd want to do the growth rates. So you'd say, okay, here's the growth rates and free cash flows. Now go map out the growth rates and earnings, and you could run the correlation and see if your assumption is good. I'm just going to assume that it holds just so I can shortcut it and keep us moving forward. So I'm going to assume that the year one growth rate in free cash flows is the same as what the year one growth rate will be in earnings. Well, it turns out that if you go to element number 613, look at what we have here. We have, according to Yahoo analyst estimates, the consensus earnings growth rate for the next year for this company. So this right here, 613, will be the consensus growth rate for the analysts who are covering ExxonMobil. So you've guessed what we're going to do. RCH, get element number, ticker symbol, and 613. So that's going to be my starting growth rate. It's now dynamic. How am I going to get steady state growth rate? And years to steady state, I don't even really want to talk about it. It's purely judgmental. You have to think about where the company is now. How long will it take them to reach their steady state? That's one of the most subjective inputs on this entire page. So I'm not going to spend too much time talking about it. But let's talk about the steady state growth rate. Here's my thinking on the steady state growth rate, and I don't claim that my thinking is perfect, but I think it's a reasonable shortcut. In my understanding, once a company reaches steady state, it will basically grow at about whatever the rate of the economy that it operates in is growing at. So I view it this way. Once a company reaches steady state, it just becomes the average company in that economy, and it just grows at whatever the average growth rate is in the economy. But I will also leave room for the fact that perhaps some companies won't be able to grow at that high of a rate. Maybe when they reach steady state, their growth rate's a little bit lower. So what I'm going to do is I'm going to make this number right here the lower of two possibilities. I'm going to make it the lower of either whatever the average growth rate has been in GDP over the last 20 years or so, because again, I'm going to assume that once a company reaches steady state, it just becomes the average company in our economy. So I'm going to assume this is either the average growth rate in GDP over the last 20 or 25 years, or it's just whatever the 5-year growth rate is going to be according to the analysts. And it turns out that the 5-year estimated earnings growth rate for these companies is RCH get element number 621. You can see right here, next 5 years for the company. So my steady state growth rate is either going to be the average GDP growth rate over the last 20 or 25 years, or it's going to be the 5-year anticipated growth rate for earnings. I'm going to take the lower of those two numbers just to be conservative. And here's where our FRED add-in comes in. What we're going to do is go to our FRED tab, and we're going to browse popular releases, and you can see that gross domestic product is here. We can either get real or we can get nominal. Many people on Wall Street will use real, but I think theoretically it should be the growth in nominal GDP, and here's why. When you actually do the discounted cash flows model, you're going to discount back their free cash flows using WACC. WACC should capture the effects of inflation. So we're going to go ahead and let our free cash flows grow at a nominal rate because we're going to discount them back and capture the effects of inflation. If you use the growth in real GDP, that means you would be taking out inflation in the numerator, and then you would be discounting back for it in the denominator. You'd be double counting inflation. I think we want to leave it in the numerator, and then we'll discount back and capture it there and get rid of it through the denominator. So in my opinion, you use nominal GDP. So I'm going to do that. I'm going to get nominal gross domestic product, and what you do is you click the Get FRED Data. It's going to take a second to pull that up. Once it does, we can actually make some neat modifications to it. So you can see that it's, first off, it's doing quarterly data. Secondly, you can see that it's starting in 1947. I don't want to do that. I want to do annual data, so I'm just going to change that to A and change that to annual. For the start date, I don't want to do that. I don't want to go back to 1947. In fact, I only want to go back 30 years because going back any farther than that, in my mind, represents economies that are not indicative or representative of what our economy looks like now. So we're going to change the start date. We're going to change it to this. We're going to change it to the date of our most recent financial statements minus 365.25 days times 30 years. That's going to take this date right here, the date of the last financial statement, and it's just going to rewind it 30 years. So that will become our start date, 12/30 of 1981. Now if we update the data, you can see that it has now turned it into annual data. Even if that says quarterly, it's still grabbing from right there. It's annual, and it only goes back to 1981. Now one thing you have to watch out for here, you're not going to get a reading in the most recent year, and so you just have to be careful of that. So once the GDP is pulled, it's very easy to figure out the growth rate for this. I'll just calculate a simple growth rate. So that minus that divided by that, send it all the way down the line, and that's all we want, is to take the average of that, and that represents one possibility for our steady state growth rate. So we could do this. We could do average, and we would just go to our steady state growth rate, highlight those cells, and there we have it. Now we might want to label this tab steady state growth rate. Come back here, up here, but now remember, I want to be conservative, so I'm either going to take the smaller of the average growth rate in GDP over the last 30 years, or I'm going to take whatever the analysts think the growth rate will be over the next 5 years for this particular company's income. Remember, I'm making the assumption that income and cash flows are correlated, which might not be the case. But if you go and look, you'll see that 621 in the RCH get element number, 621 is the earnings growth rate for the next 5 years. So what I'm going to do is this. I'm going to take the min of RCH get element number, ticker symbol, 621, or the average of the GDP growth rate. So if you look at that formula, all we're doing is we're saying, go get the RCH get element number 621, and also go get the average growth rate over the last 30 years, take the lesser of those two numbers, and that's what I'm going to use. So there you can see that the analysts right now are forecasting an average growth for ExxonMobil's earnings for the next 5 years of 0.86%. So that's the lower of the two. That's more conservative, and that's what I'm going to use. That now has become dynamic. All right, next, we need to work on getting our weighted average cost of capital, which starts with a cost of debt. In order to get the cost of debt, look, you could go and get some of this data out on the web, but What I'm going to do is I'm going to use the FRED data to get some historical data to give us some perspective on this. So I don't think you want to go to the web and just ask what is ExxonMobil's yield to maturity on its debt right now. If you did that, for instance, I'm going to FINRA and I'm just looking at market data. I'm looking at bonds, clicking on corporate, and I'm doing XOM, and I'm hitting enter. And you want to look at their long-term bonds. So if you look at the long-term bonds for ExxonMobil, the yield to maturity is going to be ridiculously low. And the reason that the yield to maturity is going to be ridiculously low is because yields right now are at historically low levels, largely because there has been government intervention to put them there. So I don't think you can trust just one data point right now. What I think is safer to do is to say this. All right, ExxonMobil is a AAA rated company. Through the FRED add-in, I can go and get historical data on AAA bonds. Unfortunately, the only options you get through the FRED add-in is you either have to look at AAA or BAA data. So you have to pick which one is most appropriate for your company. If you want, you can even make it a pull-down list, which I think I've showed you how to do before. If not, it's very easy. You just do something like this. You go to Data, Data Validation, click on it, and you just do a list. And then you would just literally put in AAA and then comma BAA, and now you have a pull-down list. So that's how you would create a pull-down list there. Obviously, ExxonMobil is AAA, so AAA is going to be the most appropriate for them. Okay, but what I want to do is I want to make it so that we could get data on either AAA bonds or BAA bonds. And again, the reason we're doing that is because we don't trust a single observation right now regarding the yield to maturity on debt for ExxonMobil. So we're going to use the FRED add-in again. And then what we're going to do is go to FRED. We're going to browse popular releases, but this time we want to look at selected interest rates. And you can see if we scroll way down, corporate bond yield for Moody's AAA. Click on that. And then mouse over a little bit. And now we want to go get BAA in case we have a company that's closer to BAA. Click on that. Click on the Get FRED Data. Okay, and you can see that it's pulled in the data for us now. Again, we're going to want to make some changes here. I don't want daily. I'm going to want monthly. So I change that. And also, I don't want to go back to 1983 and 1986. Let's just go back 5 years. So let's hit equals sign. Let's go up and grab this date and subtract out 365.25 days times 5. And we'll just hit equals and link that up. Let's refresh the data, so update our data. And now we can just calculate the average of these yields. So you can see that since December of 2006, the average yield to maturity on AAA bonds has been 5, and on BAA it's been 6.3. So we can just identify that right here. AAA, BAA, we can just take the average, do that, and again just take the average, do that, and if you wanted to you could center those things, and you probably ought to divide that by 100 because ultimately we want percent. So divide by 100 on that, divide by 100 on that, turn them into percent with a few decimal places. So those are going to become our inputs for the cost of debt, and we might as well label the tab cost of debt, so COD. All right, and let's come back up. So for cost of debt, we're just going to do this. If the rating equals AAA, then we want that. If it doesn't equal AAA, we want that. Close it up, and that is now dynamic for us. For the risk-free rate, we're going to use the same logic. Instead of going and looking at what treasury rates are right now, we know that they're historically low. Why don't we take the average over the last several years to give us a little bit more reliable reading? Now, there is some disagreement about exactly which treasury you should use. Some people would argue that you should use T-bills because those have the lowest interest rate and default risk. Other people would argue that those are manipulated by the Federal Reserve, so you have to extend it out a little bit. I know that on Wall Street, a lot of people use 10-year treasury notes. I'm actually going to pull longer. I'm going to pull 20-year Treasury notes, and the reason I'm going to do that is because our equity risk premium down here is going to be based on longer-term Treasuries. So I want those to be consistent. I want my equity risk premium and my risk-free rate to be consistent. So what I'm going to do is I'm going to go back to the FRED tab. I'm going to browse popular data releases. Again, I want interest rates. And what I'm going to select are 20-year Treasury bonds. And we'll go ahead and get the data. But again, I don't want to go back to 1993, and I don't need daily data. Let's do monthly, and let's again only go back 5 years. So let's go get our date, subtract out 365.25 times 5 years, and refresh our data. And there we have it. And now all we need to do is take the average of that. So we can do that right here. We can do risk-free rate. Just take the average of all of those. And again, divide by 100 to make it a percent. So turn it into a percent. And if you want to center it, you can. All right, so for risk-free rate, all we're going to do is go and get that. So page down to that, grab our risk-free rate. And you may want to label that as well. So there's our risk-free rate. And we're almost to the promised land here. So that is now dynamic. Now we need to get beta. If you go and look at the element numbers, 972 is beta per Yahoo Key Statistics. So what we'll do is we'll do RCH, get our ticker symbol here, 972, plug it in, but I want to make a point here. We know that empirically betas tend to revert to 1. So there has been recommended a modified beta or an adjusted beta. And the way to adjust the beta is to weight the beta that you observe by 2/3 and to weight a beta of 1 by 1/3. So we could do an adjusted beta here or a mean reverting beta by simply weighting this by 2/3 and then adding a beta of 1 weighted by 1/3. So all that is that's an adjusted beta. It's a mean reverting beta. We're taking the observed beta, weighting it by 2/3, and then we're weighting a beta of 1 by 1/3. So I would recommend that just to take into consideration the mean reversion property of beta. All right, equity risk premium is a yellow variable. I'm not aware of any place on the web we can go to scrape that. Most people go to the Ibbotson Valuation Yearbook, and it has data on the equity risk premium. Here's the unfortunate thing. If you go to the Ibbotson Valuation Yearbook, which, by the way, you won't be able to find online. You'd probably have to go to the library to get that. But if you go to the Valuation Yearbook, they will calculate the equity risk premium, which, remember, the equity risk premium is the difference between the expected return on the market and the risk-free rate. I'm looking at the 2012 Valuation Yearbook. It's a blue book. I'm on page 59. And the problem is they calculate the equity risk premium over various periods. If you go from 1926 to 2011, it's 6.6%. If you go from, for instance, 1992 to 2011, it's 4.1. So, wow, an equity risk premium somewhere between 4.1 and 6.6. That's kind of your workable range. So based on the Ibbotson Valuation Yearbook, I've chosen an equity risk premium of 5%. Again, not everyone's going to agree on that, but that is one of the common resources that we use to get the equity risk premium. All right, cost of equity then, we're just going to use CAPM. CAPM is going to be our risk-free rate plus our beta times our equity risk premium. That's now dynamic. And lastly, we need our WACC. To get our WACC, however, remember from the PowerPoint slide, we need to know the percentage of our company that's financed by debt and the percentage of our company that's financed by equity. So one of the first things we need to do is to figure out our debt as a percentage of enterprise value. So all I'm doing is taking debt divided by the value of debt plus our equity, which is our markup right there. So that's going to tell me my debt as a percentage of enterprise value. That's now dynamic. So to get our WACC, all we have to do is this. We take debt as a percentage of enterprise value, multiply it by our cost of debt, times 1 minus our marginal tax rate, which I'm assuming is 35. Again, you could make that one of the inputs if you wanted to. Add to it the percentage of our company financed through equity, which is 1 minus this debt as a percentage of enterprise value, times our cost of equity. Hit the enter button, and that's going to give us our WACC. It's now dynamic. Now, once you've done this, you just need to worry and make sure that you have all of the yellow inputs taken care of. Ticker symbols, no problem. Remember, we get the scale on the financial statements from the financial statements that you can find at the SEC website. This is a decision that you have to make based on the credit rating of the company. Is it closer to AAA or BAA? That's most easily located on finra.org. If you go to finra.org, click on Investors, click on Market Data Bonds, click the Corporate Radio button, type in your company's ticker symbol. For instance, if you wanted to do a different company like Home Depot, you could put HD in there. They're going to pull up as an S&P A3, as a Fitch A-, S&P A-. They're probably still closer to AAA, but then we might want to ratchet that up a little bit for Home Depot. So that's a choice you have to make. Are they closer to AAA or BAA? And then down here, the equity risk premium. Remember, I pulled that from Ibbitson's Stocks, Bonds, Bills, and Inflation 2012 Valuation Yearbook. There are other resources you could go to, but I'm not aware of any that we can scrape the web. Everything else should be dynamic. Now, when you want to update this, what you would do is put in the ticker symbol of the company that you want to do it for. Make sure you change all the yellow. And then you have to do two things. You have to go to all of these tabs and click the FRED Update Data button. So go to each of your tabs that have FRED data on it and click the Update FRED Data. Now, you could consolidate. You could put all that onto one tab, so you would only have to click the Update Data once. That's fine. I just keep them on separate tabs because it only takes me a few seconds to click that button. But if you wanted to consolidate, that's fine. But then lastly, in order to update the RCH get element number formulas, there's a hot button key built in with the SMF add-in. If you hit Control-Shift-R, it will automatically recalculate the RCH get element number functions. So once you've completed the process to this point, what you have is a very, very useful and dynamic discounted cash flows model. Now, obviously, we've taken some shortcuts. We've made some assumptions. So I would implore you to spend some time thinking about all of the shortcuts and assumptions that I've made. Nevertheless, it's a very useful, very dynamic model that will give you a quick way to get a quick estimate of the fundamental value of a company. Okay, now before we close up this module, I want to show you this for one other company for two reasons. First off, I want to show you that it's dynamic, but second off, I want to give you a warning. Let's do this for McDonald's, and you'll see that it updates all of the data. It does the RCH get element numbers. Now, if you look at McDonald's, one thing that's really nice about them is their free cash flows to the firm are pretty stable, which tells me that that's probably a very good launching point. In other words, the shortcuts that we took for McDonald's are probably safe on the free cash flow side. But here's one of the caveats, and this is why the finance professors at BYU are nervous about something like this. We need you to understand what could go wrong, and in order to do that, you have to have a really nice understanding of the model. So if you look at it, McDonald's has such a low beta that when you calculate their cost of equity, it's very low, and their WACC is extremely low. And I've done some conditional formatting just to warn me of that if the beta is low and the WACC is low, you're going to get a really ridiculous outcome. So I get a fundamental value of $891.02. The reason you're getting that, though, is because the WACC is so close to the steady state growth rate. If you go back to the formula, think about it. If your WACC is almost exactly the same as your growth rate, that number in the denominator is going to be infinitesimally small, which is going to explode this number in the numerator, which is exactly what's happening. Let me pull this back to 5 years so you can see it. Look at that terminal price and then look at the present value. Almost all of the enterprise value for McDonald's is coming from this terminal price, which is a direct result of this unbelievably low WACC. Now, you can do things to fix that. Like you can come in and just hard code in a 1 for a beta. Like if you think a beta of 0.54 is killing you, you can just come hard code it in, and you can do that. In fact, you could even build it into the formula, right? You could say, if you take our beta formula and that's less than, say, 0.75, then just give me a 1. Otherwise, give me this RCH formula that we did previously. So you could do that, and that gives you kind of an automatic fix for that. But I just want you to be aware, we've done a lot of shortcuts. There are a lot of assumptions that have gone into it, and you really need to be aware of those shortcuts and assumptions if you're going to use this model at all. And remember, please remember, all models are wrong, some are useful. I view this as a useful first pass at what the fundamental value could be. I hope you're able to complete this. Again, if you have questions, you can come see me or the TAs, and I will see you again in Excel Module 7.